What's going on, everybody? Alpha Investment Group here today, and we're going to talk about ETF investing and index investing. Now, what are these exactly? An ETF is essentially just a financial product whose goal is to mimic the performance of a basket of securities. Now, these can be very narrow and industry specific, or they can be very broad. I'm going to give you an example of very narrow sector specific ETFs. One has a ticker called Gamer. It's by Pure Funds. This is an ETF that tracks video gaming companies. Again, very specific and very narrow to a certain business type. Second, VHT, Vanguard Healthcare Fund. This is an ETF that tracks healthcare stocks in the US and North America. And third, HMMG. This is an ETF that tracks medical marijuana companies. And on the other end of the spectrum, we have the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. At this point, you're probably familiar with one or all three of these indexes. They are the most popular and they're talked about in the news basically every single day. They're the biggest indexes not only just in the US but in the world, and they consist of the biggest companies. We're talking Apple, Facebook, Microsoft, Amazon, etc. And for the remainder of this video, we're going to be talking mostly about these broad index investments. The reason for that is, one, as I mentioned earlier, there's companies in there that you're very familiar with. This makes it easier to kind of understand. And because they are the most popular, they're the easiest to retrieve information about, and they're the easiest to purchase because there's a lot of options and variety. So why go with an ETF investment? Well, there are a number of attractive characteristics associated with an ETF investment or a broad index fund. One is it provides diversified returns. So when the average person invests in one company or is bullish on one industry, they're subject to a lot of risk. The reason for this is because that one industry may not perform well in any given year, or they may be experiencing a disruption. It could be technological or it could be political and government. However, when you invest in, say, the S&P 500, the performance of one single industry is no longer much concern because you own all the industries, right? These include financial, technological, automobile, healthcare, industrial, and energy. Second, there's very low expenses associated with an ETF or an index fund. The industry has this thing called an MER. It means management expense ratio, and it's a portion of your returns that they take and keep for themselves for managing your investment product or your investments. However, with an ETF, there's very little management required, if any at all. And the reason for that is it's such a passive investment strategy. It doesn't need to remove companies and it doesn't need to add companies. There's no research required, so therefore the MER is very, very low. MERs are simply just expressed as basis points. The investment industry refers to a basis point as 1/100th of a percent. So 100 basis points would be 1%, 10 basis points would be 1/10 of a percent, and 1 basis point would be 100th of a percent. The third thing is what I call winners in, losers out. So the thing with these indexes is they have minimum standards that companies have to meet. This usually has to do with how big the company is or how much their price is. And companies aim to meet these standards because to be on these big indexes shows prestige and legitimacy for their business, which is good. So in the long term, the S&P 500, for example, will delist a bunch of companies that aren't performing and will add companies that are doing well and graduate into them. This is very good for the people that own these ETFs because the companies that aren't performing are no longer included in the average returns, and the companies that are doing well are included in the average returns. Here are a list of companies that have entered the S&P 500 in the last 5 years, and here are companies that have been delisted from the S&P 500. As you can see, the ones that have entered are usually good businesses, and the ones that have exited are usually businesses doing very poorly. And the fourth thing I want to add is they're very liquid investments, especially the broad index funds. They become a very big industry and you can buy and sell these funds very, very easily, though I would recommend holding them for the long term. When the time comes that you need to sell, they're very easy to sell. And the last thing I wanted to add is they have a long historical track record of doing very well. The S&P 500 has a track record of almost 100 years of performing and getting returns of 8%. Now, 8% may not seem like a whole lot, but if you continuously invest a significant or even a small portion of your income on a month-to-month or annual basis, 8% compounded can do a whole lot for you. Now, who is index and ETF investing for? It's a highly debated topic. Many people say it's a waste of time and some people swear by it. In my opinion, the ETF investing strategy and the passive investing strategy is very, very prudent for the kind of person who's not too interested in what's going on in the day-to-day markets. This is typically the person who has a life outside of the markets, who's not educated enough to invest his own money individual stock selection and is more than comfortable with making average returns, because the ETF of a broad index is average returns. It's the average of very, very good performing companies and bad performing companies within a given time period. And there are people who have the ability to blow their returns out of the water compared to these ETFs. Individual stock selection is a bit of an art and it is a bit of a science, and if you do have the time and you do have the abilities to beat the market, then you don't really need to be at the performance of the market, because you can be doing better. Now with that being said, a lot of people don't know how to do individual stock selection, or they're scared by it, and they should be. It is a very hard thing to do. If everybody could profit from it, then everybody would. But there are a few people who can beat the market consistently, and this is presented with a substantial amount of data, and I'll provide some links in the description below. But for a long period of time, people were paying mutual fund managers who do active management to try and beat the market, but most of the time they would fail or they wouldn't be able to do it consistently. So why provide such high expenses to these mutual fund managers who make millions of dollars a year when they can't even get the average returns? Wouldn't it be better to get average returns and pay extremely low expense ratios? That's kind of the premise behind ETF and broad index investing. There are a lot of people who support it too. For example, here's a quote by Warren Buffett. He says that for the average American, ETF investing and broad index investing is an immensely important strategy to have to increase your wealth over the long term. However, if you feel like you can beat the market, then you can always have it in a small portion of your portfolio. I am by no way recommending that this is the only thing you should invest in, but a long-term statistical record shows that you will make some gains if you hold it. Now, to add my own personal touch, I personally invested in the S&P 500 ETF by Vanguard. It's called VOO, that's the ticker. I wouldn't be too worried about which one you pick. They are all relatively the same. But in December 2012, I got a little bit of money as a Christmas gift, and I didn't have so much that I wanted to buy, so this was at the beginning of my investment days, and I decided to buy this ETF. I held it all the way till October 2014, and I made a pretty good gain, as you can see from this graph right here. Now, at the time, my thinking was, oh, the markets are continuously rising, and maybe this is a good time to pull out. I thought that maybe they were rising a little too much for my comfort. Now, I will add, because I don't want to be too biased, ETFs are by no way the perfect strategy. There are a few tech companies out there who have blown ETF returns out of the water, and if you do want to invest more of your portfolio in one company and you believe they do well, all the best to you. But I do have confidence in ETFs providing pretty good returns, and their returns do mimic the performance of their relative index. Here's three big ETFs that I will show you, and I'll show you a graph of the SP 500, but I won't label them, just to show you that they are very similar. One is by SPDR, its ticker is SPY. One is by iShares, its ticker is IVV, and one is the one I already mentioned by Vanguard, its ticker is VOO. As you can see, their graphs are very, very similar to the S&P 500. This kind of shows that they are very successful in mimicking the performance of the market. One final thing I'd like to add is the S&P 500 and markets in general in the US equities market are at all-time highs, so I would invest with a grain of salt, and I would take my opinion with a grain of salt as well. The reason for that is because typically when markets continuously rise, there is a pullback. History has shown us this. Well, that's all I really have to say about this topic, guys. If you did like the video, please click like. If you have any comments or any feedback, both positive and negative, I would love some feedback. This is my first video ever. However, I do aim to make more videos like this related to economics and finance and business. I do hold a business degree with a double major in economics and finance, so I want to put that knowledge to a bit of use. So that's why I made these videos. I'm going to make some more like this. I hope you stay tuned and I hope you learned something. That's all for now. Ciao.